Today, we're going to dive into what investors should think about. I'm excited to talk to you about this, Phil. One of the key things that we know here at EquityZen and would love to get your thoughts on is why experience matters. Can you dive into that a little bit when it comes to the platform you're using?
Yeah, absolutely. So I think the first important thing to talk about is that this space is pretty new. Secondary transactions haven't been around that long. Probably the first version of these was employees at Facebook or ex-employees at Facebook were selling their shares in 2009, 2010. So really this kind of space is only like 10 or 15 years old. Having said that, there are certain platforms, like ours included, that have been doing this for over 10 years, 11 years at this point. So it's like most of the life of the space. And what I think is really important on the experience side is that each transaction and each company that you do a transaction in is completely different. And these transactions aren't like clicking a button in your Robinhood account to buy shares. They require legal documents. They require adherence to regulatory requirements, right, from FINRA and the SEC. You want to make sure that the company is signed off on transactions. So there's just like a host of steps that basically make it really important that whoever you work with understands the transaction. Because again, it's, instead of buying something online, it's basically like a very bespoke transaction as much as we try to kind of like technologize the process.
So as companies are staying private longer, this market has really grown and there's really more players than ever. So how should investors be thinking about that, Phil?
Yeah, the space has grown a lot since kind of 2012, 2013. There was this huge wave of kind of capital coming into the private markets, basically investors more comfortable with companies being private longer. The time to go public has gotten longer as a consequence. The number of publicly traded companies has gone down as well. And so if you look at this space, it's grown tremendously. I think the number of unicorns when we started, companies worth $1 billion or more, was like 40. And now it's, in the thousands. And so there's just a much wider range of opportunities and therefore a much wider range of potential complexities in the space. And so somebody that's done this, for 10 plus years will know how things have evolved over time, which regulatory changes have happened, what company sensitivities are, and those are really important. So the last thing I'd also say is a platform that's been around for a long time has a lot more transactional data about who's buying, who's selling, prices, et cetera. So it's likely that someone that knows the space longer and has collected and amalgamated all of that information is able to probably provide a better experience, better tooling, better, research capabilities for you as an investor as well. So I think it's really important.
Yeah, and I think it's especially important for investors who are new in this market. So for those who don't know, private companies don't have to disclose the same level of financial information that public companies do. So for new investors in the space, the question we hear a lot is, how do I understand the value of a company I'm investing at? How do I know if this is a fair price? And the more you can work with a platform that has historical data on where companies have traded over time and gives you tools to understand the price per share you're buying versus where maybe that company last raised funding or where their competitors might be trading, all of that really helps investors make more informed decisions. So it's really important to think about.
All right, Bree, so let's talk fees and what it costs to transact or invest in this space. There's a lot of financial jargon that goes around management fees, carry, transaction fees, et cetera. I'm sure that each platform does things a little bit differently. Maybe give a kind of a bird's eye view of what potential fees are involved and maybe why those fees exist as compared to somebody investing in maybe the public markets where they're kind of used to commission-free trading and all these things like that.
Sure. So to kind of answer that first question of why there are higher fees to invest typically in private companies for public companies, the process of these transactions a lot more time intensive and bespoke than, buying shares through your brokerage account in a publicly traded company. So there's a lot more that goes into working with a company to get approval and making sure that these transactions are happening, in a scalable and safe way for investors. So that's what a lot of those fees help cover. When we're talking about the different types of fees, there's a few different buckets. The first is a one-time brokerage fee. So a lot of platforms like EquityZen charge investors a one-time upfront fee to invest in a given private company. That fee can range depending on the platform you're investing on, but that's a typical fee that investors may see. Other platforms charge ongoing fees, which can kind of fall into two categories. One can be a management fee where you're paying a percent of your investment amount every year to help cover costs associated with holding that investment. And then the other being a performance fee or carry. So when a company does IPO or go public or has an acquisition event, whatever it is, you are paying a percent of kind of the gains you've made in that investment back to the marketplace or the platform where you bought those shares as a fee as well. So that's another type to look into. I would say the two other main ones to look out for are layered fees. So typically for accredited investors, when they're investing in private companies, they're investing in an SPV, which is a special purpose vehicle that holds shares of that. So you're investing into SPV that owns shares of company A. In certain circumstances, that SPV may not actually hold those shares, but they may be investing in another SPV that owns those shares. So it's important to look at the offering documents of the offering that you may be investing in to understand what are the fees of the SPV I'm directly investing in, but then also this other vehicle that I have exposure to that's actually owning the shares. And then finally, there are some platforms that charge markups as well. So maybe they say that they don't charge traditional fees, but instead of offering company A shares at $10 a share, they're offering those shares at $13 a share. So you're essentially paying a 30% markup on those shares, and that's the way they make money. So that's where it becomes more important to really understand the valuation that you're investing at and the net price you're paying, whatever the fee structure is for those shares, so you can understand if it's a fair price and if you see upside from there, because of course investors want to invest in companies where they think there's upside potential.
Yeah, I love real estate analogies because I feel like most people have gone through either buying a house or renting a house, and I feel like there's like one for each of these. So there's kind of the brokerage fee. So you buy a house, you pay a real estate agent a percentage of what you bought the house for. That's one time, and then if the house appreciates in value or you rent it out or whatever, all that money's yours, right? That's kind of like the upfront fee version. And then there's also like the property manager example. I buy a house, but I need someone else to manage it for me. Hopefully it generates some income. They get a percentage of that over time. That's kind of the management fee example. And then there's like the shared upside version, which is the property manager, or maybe I hire somebody to buy a house for me and then with the intent of selling it later. And I say, whatever you find as a sale price, if that's above what I paid up front, you get a cut of basically the proceeds. That's kind of like the carried interest version. And then the SPV version is like, the layered one is like, there's a house that has a house inside and that house has a property manager, and that just gets really convoluted. But so a lot of different fee structures. Probably seems like what's important for investors to know, kind of like comparing if they're going to invest on one platform with a upfront fee versus another one with management fee, carry, all those things. They should be able to kind of like compare the two. So let's use an example. Somebody buys on one platform, they make a $100,000 investment, and it's got like an upfront fee, and somebody makes a $100,000 investment on another platform that's got management fee and carry, and then the company ends up exiting and the person's value of their investment was $200K at the end. Maybe like walk through kind of what the differences might be for each of these people.
Yeah. Okay. So let's talk about the one-time fee model first. So if someone makes a $100,000 investment, they are being charged 3% one-time fee. They're paying $3,000 upfront for that investment. Let's say the company, doubles in value. That investment is worth $200,000 when there's an IPO or exit. All of the proceeds of that, the gains they had, they get to keep. In the case of a management fee and carry, let's say the investor is being charged a 2% management fee. So that means on an annual basis, they are paying $2,000 to whatever platform or investment manager they're working with to really maintain that investment. So if they hold that for 10 years, that could add up considerably. If they have it for 5 years, we're looking at $10,000 of fees then. Let's say that same company then still exits at a 200,000 outcome, so a double for that investor. Of that $100,000, they're paying a percent of that gain to the platform that they purchase shares of. So that's, another piece of the cost. And then in the third kind of scenario of maybe a markup, they're, buying the number of shares that they're able to buy with $100,000 would just be less than they would, if they weren't paying a markup, because the price per share is going to be more. So that's why it's important to kind of understand the price per share. And
I always tell investors, okay, think about how much money you're going to spend on the investment, including the fees, right? And think about how long it might take for this investment to be realized and what you think the exit price is. And then basically look at the return profile of each, right? So in one example, you had to pay $100,000 plus $3,000. So you put in $103,000 and you got back $200K. So you're going to make $97,000 on that 103. In another version, you put in $100,000, you paid $2,000 in management fees, right, for like a couple of years, depending on how long you think it is. And then when the company exits at $200,000, you have to give up some percentage of that gain between the 100K entry and the 200K exit. So that's something. And then kind of look at those so that you can kind of compare. This is the brokerage fee example and how I'm going to do. This is the management fee and carry example and how I'm going to do. And then with the markup one, I think it's really just a question you need to ask of, what's my entry price going to be? Because typically what we see is those platforms that have, sometimes some kind of markup will say there's no fee, but really instead of getting in at, $50 a share with some fee, you're getting in at like $60 a share with no fee. But if you compared the two kind of net, you might be better off to use the one that had the upfront fee like kind of displayed to you.
So we're talking about a lot of these different fees. At the end of the day, how can an investor understand the price that they're actually paying for shares to quantify if that's a fair price and, one that's attractive to them for making an investment?
Yeah. So let's say you've committed that you want to invest $20,000 into Unicorn Corp, right? I think the best way to think about it is in exchange for the $20,000 that you're investing, what are you actually getting? It's usually like kind of an equivalent of a number of shares of Unicorn Corp. And so what's really important is you understand the $20,000 is going to get you 1,200 shares or something like that. You should calculate what that means on what you've paid per share, right? And how many shares you own, and look at that versus each of the offerings. And the reason why that's important is that if you put in 20K on one platform and you paid some fee and you got 1,000 shares, right? You basically paid like $20 a share. If you do it on another platform and you get 800 or 80 shares, then you paid, or 800 shares, then you paid $25 a share. That entry price is really what matters, because ultimately if the company exits at $50 a share, you're going to do 50 minus 25 or 50 minus 20. And that's really where you'll see kind of the difference in gains. And it's unfortunate that you kind of have to do this comparison all over the place, and that there isn't one unified standard way of doing these things. But the space is only like 15 years old. People have different incentives, and it's just something we encourage people to spend the time diligencing before they make the investment. I think one of the things that's important for investors is to realize what they're buying. And I know that sounds so trivial, but really in this space, there's a lot of structure and complexity into how each of these transactions are put together. You would expect that or hope that it would be as simple as, I'm buying 100 shares of Unicorn Corp from this person that holds 100 shares of Unicorn Corp. And that is one version of how these transactions happen. But Bree, maybe talk a little bit about other types of structures and the risks involved, and maybe the questions investors should ask so that they know what they're actually getting.
Sure. So Phil, the example you just gave is a direct transaction, essentially, where one buyer is buying shares from one seller, and essentially that new seller will then be sitting on the cap table of the company. So that's probably the most similar transaction, I guess you could consider, to something that happens in the public markets, where you're investing directly. A more typical structure, especially for accredited investors in the private markets, is to invest into an SPV or special purpose vehicle that owns shares of one given company. So that SPV then is the entity that is buying shares from the selling shareholder. and that SPV is therefore sitting on the cap table of that company. So when EquityZen does a transaction via one of our SPVs, and we've done thousands of these, essentially we are going to the company and saying, hi, can EquityZen's fund buy shares from XYZ shareholder? And if the company says yes, then our fund is sitting on the cap table, and each of our investors in that fund owns their pro rata right to the number of shares that the fund is buying. So that's a really typical model. It allows for lower investment minimums because we're able to pool many investors into one entity. So that's a really typical structure you'll see. And it's one where you need to go to the company to get approval so that that fund can actually own the shares. What happens sometimes, and this is a structure that maybe it's worth looking out for when you're investing, is a company may not want so-and-so new shareholder to be buying shares. So as a way of getting around that, some platforms may offer forward contracts where you're essentially the company, or not the company, rather, the shareholder is signing an agreement that says, I can't transfer you these shares now because the company won't let me, but I promise that when these shares are liquid, I will deliver these shares to you at the price per share that we discussed. There's a few risks to that. One, let's say the shareholder is selling to you at $100 a share, and when the company actually goes public, that company's trading at $200 a share, and they decide, wait, I actually don't want to deliver these shares. I'm losing a lot of money by having agreed to sell at this price. So there's counterparty risk in that type of transaction. And then there's also the risk because these companies, or these transactions rather, are not recognized by the company. So there could be legal risks that come into play as the company is preparing to go public and cleaning up their cap table and realizing that people own shares that they don't actually want owning shares. So that's another structure that is really important to look out for. And I think it's one that's also made some companies a little wary of these transactions. So we really focus on working with companies closely to make sure they know who we are. They know that we will work with them to buy shares so that we can offer more attractive investment opportunities to our clients at the end of the day.
Yeah, I always talk about follow the money, right? So if I'm going to give this platform $20,000, what is that going to go into or towards? Most cases, it's going to go into some type of vehicle. That vehicle is going to hold something. Your next question should be like, what is that something? Is it the actual shares, right? And if it's the actual shares, you can get the company to approve it. If it's into another vehicle, what does that vehicle look like? And you got to be able to basically connect yourself to the shares at the end, right? Hopefully it's not some giant daisy chain of things, but sometimes it is. And I think that's probably the most important aspect. And it's, unfortunate there's all of this financial engineering that's happening in the private markets. Again, it's pretty nascent, the space. So hopefully you see less of that. But I think the biggest question is kind of what am I going to end up owning? How do I actually own the shares? How do I have confidence that if this does work out and is successful, that I will get the proceeds I expect?
So unlike when you're buying shares of a publicly traded company and that transaction is going to happen almost instantaneously, that's not always the case when you're buying shares of private companies. So let's talk a little bit about the likelihood of success and what investors should know as they're considering buying shares of a company.
Yeah. Well, you hit the nail on the head. Very different than public company transactions, right? Where things are going through exchanges and they're crossed and they close instantaneously. For any private company transaction, the transaction should get submitted to the company to basically notify the company that buyer A or a fund or something plans to buy shares from seller A, right? And a company really has two important decision points that are in their control. One is that in a lot of instances, companies have the right to just say no and say, we don't approve this transaction because of the buyer or because of these bylaws or something like that. And then the transaction gets basically completely blocked and shut down. Buyer doesn't get anything, seller doesn't get anything, kaput. There's another kind of version in the middle where a company can, you submit your transaction to the company. Company says, I see it, I'm looking at it. And the company typically has what's called a right of first refusal, which means that the company can elect to buy those shares from the selling shareholder, seller A. at the same price and terms and quantity as what was proposed. So think of it as a way that, if the company thinks it's a decent price and they have some extra cash on their balance sheet, they can just buy the shares. Now, in that instance, still not a great outcome for the investor because they don't get actual ownership of the shares. The seller in that instance is kind of, agnostic to that outcome because they're still getting the proceeds for their shares, right? Someone's still buying their shares and still getting liquidity. And I think like some high level stats, at least at EquityZen, is we see deals get, ROFR, right of first refusal. We see deals where companies exercise their right of first refusal somewhere between like 5 to 15% of the time. So this isn't, it's non-zero. It's infrequent, but it's non-zero. And then probably less than 5% of the time, we'll see a company outright block the transaction. But that's really because, at least, speaking for our own platform, we do a lot of cursory work up front on whether somebody can actually sell or not. And if we don't believe they can sell, we're not going to put our customers through the burden of hopefully getting something that they're not actually going to get. And so that's probably a good question to check if you're like working with any platform is, if we submit this trade, like what kind of work have you done to confirm that I can actually buy these shares or get exposure to these shares? I think it's like a really important aspect. All right. So Bree, I think we've talked a bit about how these transactions are very different to public companies, right? Where you can buy and sell quickly. And one of the things that's an important aspect about public markets is that there is a lot of liquidity. You buy shares of IBM, tomorrow you decide you don't want them anymore, or you need the cash for something, you can sell them quickly. How does that compare to private markets, kind of like the pre-IPO secondary space? Like what are some considerations people should think about?
Sure. So generally speaking, when you're buying a pre-IPO investment, this is an investment that you should plan to hold longer term. So we typically say 2 to 7 years is an expected, time horizon for someone to hold an investment in the private markets. It could be longer, it could be shorter, but that should be the expectation. So because of this, let's say you're trying to put a down payment on a house in 3 months. Don't use that money to invest in the private markets. You really want to use long-term capital that you're looking to really have appreciate in value over time. So that's an important consideration. And in most cases, when you do buy shares pre-IPO, you are expected to hold those shares until there is an IPO or an exit. In the unfortunate case, there could be a bankruptcy or, the company goes under too. But those are kind of the typical avenues for an investment to exit. Some platforms like EquityZen provide opportunities for pre-IPO liquidity. So that's something that can be attractive to investors who bought a position, it's appreciated in value, and they want to exit that position before there's an IPO or an exit. On our platform, we call those express deals, where essentially an investor can sell their LP stake in one of our funds to another investor. It's certainly not guaranteed that there'll be another investor that is looking to buy at whatever price an investor or you, the investor, is looking to sell those shares, but it is an option for near-term liquidity. So that's something to consider. Are there liquidity options that I could consider pre-IPO depending on where I invest, and what is the likelihood of that transaction being able to happen? But at the end of the day, investors should really be thinking about investing in this market with capital that they're okay, having illiquid or held up for a longer period of time.
So basically, like the baseline expectation is what you're going to invest in. If you need that cash near term, you probably shouldn't be using that cash, and you should be expecting you're going to hold this for a while. However, it does depend on which platform you use or which structure you use. You may be able to still get liquidity for your position before there's an IPO or acquisition or bankruptcy. But really kind of the devil is in the details, and it's probably a worthwhile question to check before you make the investment.
You've learned a lot about pre-IPO investing, all the things to look out for. You find an investment that you find to be attractive. What are the investment minimums that investors can expect when they're investing in this market? And what are some of the things to think about when writing that first check, depending on the platform you're using?
Yeah. Well, I think the first thing to consider is that the check you're going to write in to invest in a pre-IPO secondary company, that investment is going to be probably pretty illiquid and probably part of your overall portfolio of publicly traded stocks and your 401k and I don't know, treasuries or like a money market fund and all sorts of things. So I think the important part is to first look at what your portfolio individually looks like and how you can make an investment in the pre-IPO markets and how that kind of fits into everything. And the reason why that matters for investment minimums is that let's say you have a $500,000 portfolio, right, of like kind of like net worth of things you own. If the investment minimum you come across is like $100,000, which is not that uncommon, is it really prudent for you to put in 20% of all of the money that you saved up, life to date into one single, relatively liquid, quite risky equity investment, right? I'd say most financial advisors would be like pulling their hair out right now just even to think about that. So the reason investment minimums matter is that the lower the investment minimum available, the more likely you can make one of these investments into and put it as part of your portfolio construction in a way that kind of makes sense overall for you. So at EquityZen, we have a $10,000 minimum, which we think is pretty competitive and also provides people to have, exposure to this space without completely leveraging themselves to pre-IPO. You might see 20K out there. You'll see 50 to 100K. It really depends. But I think what matters the most on investment minimums is that it can fit kind of your investment profile and your net worth and your portfolio in a way that doesn't kind of trip you into an area of being a lot higher risk or having a really illiquid portfolio. And it also allows you to make multiple investments if the investment minimum is smaller. Instead of having, a bet on one horse, you can bet on multiple horses. That's also important too.
To learn more about EquityZen and get started as an investor, visit EquityZen.com/investor and click Invest Now to start your pre-IPO investment journey.